If you're looking to enhance your options trading portfolio with strategies that offer flexibility and large potential for profit, you're in the right place. Today, we're diving into three strategies that are very powerful: the leaps, the poor man's covered call, and the iron condor option trading strategies. We'll start off and explore the leaps option strategy. And leaps are long-term options that really allow you to utilize capital efficiently. Then we'll jump right into the poor man's covered call, which is a play on the traditional covered call, and you can collect monthly income but utilize much less capital as well. And then we'll finally jump into the iron condor, where you benefit by a stock trading within a range. And again, you collect that monthly or weekly income. So stay tuned as we jump in to live trades on the option trading platform, and we give valuable insights to these three different strategies. Guys, before we get started, go ahead and hit that like and subscribe button down below. Let's get at least 100 likes on this video. Also, download the free options workshop in the link below. It talks about the two main benefits of trading options over buying stocks. Guys, LEAPS stands for long-term equity anticipation securities. And LEAPS are a little bit different than regular options because they have a longer time frame or date until expiration. They typically expire 9 months to a year, even up to 2 years until expiration. The key features of LEAPS are extended time frame. So again, like we talked about, the longer period for your investment thesis to play out, so it reduces the impact of short-term market fluctuations. Leverage, like all options, LEAPS allows you to control a large amount of the underlying asset or stock with a very much smaller amount of capital. And risk management. When buying LEAPS, your max loss is limited to the premium paid, which is significantly less than purchasing the underlying stock outright. If you have 100 shares of the underlying stock and the stock price drops, you can really get hurt. With LEAPS, one option contract controls 100 shares of stock. LEAPS can be used as a stock substitute. And if you consider buying 100 shares of a stock that is priced at $100, then you're talking about a $10,000 investment up front. Now, one option contract that controls the 100 shares in a LEAPS contract would maybe cost half that. So let's talk about some of the key considerations for LEAPS trading. For LEAPS trading, you have higher premiums. Due to the longer expiration, LEAPS typically have higher premiums than short-term options. Time decay. While slower initially, time decay accelerates as the expiration date approaches. And expiration risk. Remember, even long-term options eventually expire, so timing is crucial. By the way, if you'd like to receive my free options strategy trading guide that outlines all the different option strategies and management of those strategies, comment options guide down below and I'll send you the link. All right, guys, let's take a look at buying a LEAPS option in ticker symbol MU, which is Micron Technology. Now, Micron is in the memory and storage market. So computers and AI, for AI right now, data is huge. So great stock with a lot of potential for growth. And you can see here on the RSI, it's down and the stock is trading below the 200-day moving average, which is the yellow. The green is the 13 and the red is the 50. So these are items that I look at. So we want a stock that we expect to move up. This is trading at $100 right now. And the fundamentals for this stock are excellent. If you look at the financials, you look at the annual income statement, and revenue versus net income is increasing. And same with the balance sheet and the assets and liabilities. So a great potential stock, and I like it long term. So we punch in MU in the upper left. We're on the Tasty Trade platform. There's links down below for both Tasty Trade and Moomoo. Great option trading platforms, both of them that I use, and there's some benefits if you go through my link. And if you have any questions, comment down below. Let me know if you're using either one of those brokers or who you're using. Interested to hear and how you like them. So now we go to the trade page here, and we are going to open up. Here's the days to expiration right here in the middle, and then we've got calls on the left, puts on the right. So actually, let's open up the January 16th, 2026, and right now it's December 2024. So this is over a year out. January is 409 days to expiration. So let's open that up. And then the stock's trading at 100. Let's look at the 95 strike, and we're going to click on the calls on the left and the buy, which is the ask. We'll click on that 24.35, and we'll put here in the middle. We'll look to get filled at the mid price, 24.20. So this is $2,420 since it controls 100 shares of stock, one contract. So 2,420 is the max loss. So that's what's nice about leaps as well, is the most you can lose is $2,400 versus if you own the stock, it would just have to drop from 100 down 2.4%. And I mean, you can lose a lot more when you're trading with the actual stock than you can utilizing an option. So 100 is the price. If we go to the curve mode, this is what I like about Tasty Trade platform, and then analysis, you can see right here as we move forward, it goes up in value just like owning the stock. So if we get up to 145, we make back 100%. Our profit is $2,580, so more than we're putting up front. But this is the power of the leaps option. So you go ahead and hit review and send and place the trade. Now let's talk about the poor man's covered call, where we can actually collect some monthly income. Now, the poor man's covered call replicates the benefits of a covered call, but with significantly less capital required. So instead of owning the underlying stock, you purchase a in-the-money call option that is out in time, 9 months to a year to 2 years. And this is referred to as the leaps option. This acts as a substitute on the call itself, and then you sell a short-term out-of-the-money call option against it and collect monthly income. So why choose the poor man's covered call? I knew you were going to ask that. Lower capital requirement. Unlike traditional covered calls that require purchasing the 100 shares of the stock, the poor man's covered call allows you to leverage options to mimic the position with less than half the cost. And it's an income generating tool. By selling the short-term call option, you can generate regular income from the premiums received, similar to covered calls. And risk management. The max potential loss is limited to the initial debit that you pay for the long-term, the leaps option. So it's much more controlled as far as risk goes. So Darren, how does the poor man's covered call work? Well, you buy the long-term in-the-money call and you purchase a deep call option with an expiration date that is, around a year out. This serves as your long position in the stock. Then you sell the short out-of-the-money call with a shorter expiration date. I like to go between 30 and 45 days to expiration. This generates premium income and it caps your profit potential at the strike price of the short call. And for profit and loss, your profit is capped by the strike price of the short call, but the benefit from the premium income and potential appreciation of the long call is absolutely fantastic. And you'll see in this upcoming example. All right, guys, so we've already got a leaps option in Micron, and Micron is the perfect stock for the poor man's covered call strategy because we do expect Micron to continue to go up in value. So here's the leaps that we just showed how to go ahead and purchase, and the price $24.20. Actually, it's $24.10 right now. So we'll take this leaps now. Go to the table mode, and we will close up this January 2026 409 DTE leaps option. We're going to open up now the 45-day to expiration chain, which is January 17th, 2025. And what we're going to do is we're going to sell a call against this position. So we've got the calls on the left, and we've got the buy, and then we've got the sell. So we want to sell, and we're trading at 100. This orange line is the at the money price right now, 100.72. So we're going to go out about the 27 deltas. I like to go anywhere between 20 and 30. So this still allows upside to 115. So a 15% 1 month return we can make on this leaps option going forward if it moves up. But if it doesn't, then we keep this $285 that we're going to collect. So watch, when I hit this 285, you'll see this 24.10 price come down by $284. There you go, 21.24, 21.27. So we can go ahead and hit review and send and place this trade. Now, keep in mind, it caps our profit when we do this. And what I'm going to do just to show you, we're going to take off this leaps right here. We'll clear that. And I want to show you just selling the call. So we sell this January 17th, 45 DTE, call it 285. And we can go to curve mode, and you can see we profit as long as it stays below this 115 price. Then we keep this $285. So we do this every month. So around 10 to 15 days, I'll go ahead and roll out my call to the next month. But just think, if we collect $285, and maybe we won't keep it the full 45 days, so we'll roll it 10 to 15, but still, if we keep a couple $100 a month, then over time, over 12 months, that's $2,400. That basically covers the cost of the leaps option. It was around $2,400 as well. So that's what I love about this strategy. We hit review and send and place the trade. Now let's take a look at the Iron Condor option trading strategy. This benefits us when the stock price stays within a trading range. Okay, you're probably wondering, how does the Iron Condor work? Well, we're going to sell two credit spreads, a put credit spread and a call credit spread, and collect premiums on both sides. So the Iron Condor involves creating those spreads using 4 option contracts. We'll sell an out-of-the-money call option slightly above the current market price, and we'll sell an out-of-the-money put option slightly below the current market price. So this is basically a strangle. However, we're going to buy a further out-of-the-money call option as protection at a higher strike price than the one that we sold. And then at the same time, we will also buy a further out-of-the-money put option for protection at a lower strike price than the put that we sold. So what do you think the benefits of the Iron Condor are? Well, consistent income. By collecting premiums, traders can generate steady income if the market remains fairly stable. It's also defined risk. So it's defined risk and reward. The strategy offers a clear understanding of the max profit and loss, and it really controls your risk. And it's flexible. Traders can adjust positions based on market movements, such as closing one side of the trade or shifting the entire range by rolling the untested side and collecting additional premium. Okay, let's look at selling an Iron Condor in gold. We're going to punch in on the upper left here, GLD is the ticker, and this is the Spider Gold Trust gold shares. So we're going to go to the table mode on trade page on the Tasty Trade platform. We're going to open up 45 days to expiration, the January 17th, 2025 option chain. And I'm going to look at about the 28 delta. Now, puts are on the right, calls are on the left. We're going to sell the closer to the money. So the price is 244. So we're going to sell the 28 delta. If you look right here, here's the delta. So 28 and so it's the 238 strike. And then we're going to go $10 wide, and we're going to buy the 228. So we're going to collect $1.52, which is $152 right when we hit review and send. And our max profit is the 152. Our max loss is 848. Our probability of profit is 75%. It really should be 72%. It's 100 minus the 28 delta. Now, what we're going to do though is this is the put credit spread. Now we're going to sell the call credit spread, and we're going to go. Actually, you know what? Let me show you on the curve mode. real quick, you see we're profitable if it goes up. Now what we're going to do is sell the call side, and we're going to be profitable within the range. But let's go here. Okay, now let's go to the 28 on the call side on the left, and the 28 delta right around here, 253. So we're going to sell the 253, and then we're going to buy as protection the 263. So now we're collecting $3.17, which one contract controls 100 shares, so that's $317. Now we can't lose on both sides, so our max profit is the 317 that we collect up front when we hit review and send and place the trade. Our max loss is that $10 width of the spread minus this 317 collected, so it's 683, 684 now. It's moving back and forth, but that's our max loss on this. Now if you go to the curve mode, you can see the profit range. As long as we stay between this 235 and 255, well, we collect as long as we stay above 238 and 253, we keep that entire $316. And we're break even is down here on the left, around 234, and then over here on the right around 256. So 234 to 256. If we go to the chart, that would be, we can look over here, 234 down here. It's not letting, oh, there we go. 234, and then what was the profit zone? 256 basically. So we go to the chart, 256, yeah, right about there. And we just need to stay in this range, and you can see it's been trading in this range recently. We're right in the middle on the RSI, the relative strength index, so it's fairly valued right now. I think gold is going to continue in this range. So we go back to the trade page, we hit review and send and place the trade. All right, guys, there you go. Those are 3 game-changing strategies for 2025 that you'll have in your options trading toolkit. Be sure and hit like and subscribe down below. Let's get this video out to as many people as possible. Let's get 100 likes, and be sure and download the free options workshop in the link below as well. Leave a comment, ask a question. I answer everyone. Let me know which stocks you're trading with these strategies. All right, I'll see you in the next video. Talk to you soon.